What's up, y'all? Um, Welcome to Wall Street Wednesday. I'm trying to get situated here. But welcome to Wall Street Wednesday. Um, First, I got to shout out to brother Sherrod Cohen for the T-shirt. Um, just got those in the mail today, right on time for today's occasion. Like I said, earlier in the week, today we'll be talking about what is an option. So that, of course, will be geared to more so to the newbies in the markets, those who haven't quite hopped into options yet, or those who are very interested in diving into the world of options. And then the second portion of this presentation will be geared more toward people who are already um, kind of heavily involved in options already. Of course, that's going to be from a technical aspect. Kamisha, what's happening? What's going on down there in Port City? Um, Hope the weather's nice and not super rainy like it is up here. But thank you for watching. Thank you for joining. I appreciate you. Appreciate your time and your support as always. So yeah, let's just dive right into it. I hope you guys can see this all right. My pins are a little little dull. But anyway, so what is an option? So to put it simply, to sum it up in just one word, an option is a derivative. So a derivative is simply a financial contract with a value that is derived, keyword derived, like we're derived from our parents, whatever. What's up, Sharika? Thank you for watching. So yeah, it's derived from an underlying asset. They have no value in and of themselves, and the value is based on the expected future price movement of its underlying asset. So moving on further, what is a contract? See, I have a contract here in a box. That's going to become more clearly. That's going to become more clear as I move on. But anyway, so just remember that a contract is basically an agreement that facilitates control. Very important word is control. Remember that word, control. Underlying asset, very important, right from the definition here. Underlying asset, simply that's just stocks, futures, ETFs, indexes, whatever. So the overarching theme here is that options do not exist without the underlying asset. That's probably the most important thing to know. If it wasn't for stocks, if it wasn't for ETFs, futures, options, they would be nothing. So that's the whole purpose of them being a derivative. They're derived from stocks, from ETFs, indexes, futures, whatever. All right, so let's get to an example. I want to show you like a real life example of why options are so powerful and how they're so powerful. Another very, if I can get my little, okay. Another very important term to remember about options is leverage. That's a one-word answer to the question of why options are important and attractive and so powerful. All right, so if you can get out your little sheet of paper, you can make your little T-chart type situation. All right, so we're going to discuss stocks over here, because remember that options do not exist without stocks. And then we're going to do options on this side. All right, so continuing on from our definition that we just talked about, contract. So on the stock side, of course, you purchase shares. So you buy shares of stock. On the option side, you purchase contracts. Okay, so what's the difference between shares and contracts? Remember from our definition, contracts facilitate control. Whereas, yes, ma'am, Charlotte, please share. Thank you, ma'am. Thank you for being here. Thank you for your time. So yeah, contracts facilitate control. It's all about control on this side. But on this side, it's ownership. Sorry for my sloppy handwriting. I can't write well, very big. But anyway, so we're looking at shares on the stock side, and we're looking at versus contracts on the option side. We're also looking at ownership on the stock side versus control on the option side. Very important stuff. All right, so another, just moving on further from what we were discussing. We'll, in order to keep it more uniform, let's just say we're going to do blocks of 100. So 100 shares on this side. You can buy 100 shares of stock. You can buy one stock, one share, 100, however many you can afford, whatever. All right, so, however, get into leverage. Remember this word, leverage. All right, you can leverage your money over here. All right, so 100 shares, one contract. So what does all this mean if you put it all together? This is telling you that one contract in an options, one option contract allows you to control 100 shares of that underlying asset, being stock in this case. So that's what that's saying. I hope that's pretty clear. But that's very important to remember. One contract allows you to control, not own, you control with the purchase of this contract 100 shares of that stock, of that underlying asset, being a stock in this case. So another thing about options is that you can make money in any type of market. So what you can do is, if you suspect that the market's going to fall, you can do something called purchasing a put option. So a put option allows you to make money when this underlying asset is decreasing in price, like Facebook is currently doing, tanking in the after hours activity because it missed on earnings. But anyway, so another thing that you can do is, if you suspect that the underlying asset, being the stock, is going to increase in share price, you can buy something called a call option. So that's the two most basic. What's up, Robin? Thank you for joining. So those are the two most basic ways to profit off of options. It gets a lot more complicated with multi-leg options and bull spreads, bear spreads, just all kinds of stuff. But these are called single leg strategies, because you're just buying on one side of the market. Yeah, one side of the market. Put option and call option. All right, so on the stock side, when it comes to making money, generally speaking, you can only make money as the share price appreciates. But when you are when you are a long-term shareholder in a company like Coca-Cola, for example, what you might do is, if you suspect that maybe you get some kind of news, some kind of rumor comes out, and it's gonna negatively impact the stock. So while you're like, Coca-Cola is a great company, um, I don't want to get rid of my position at all, but I do want to hedge because I know that the long-term value of my portfolio is going to decrease because of this. What's up, Core? What's up, Theodore? Thank you for joining. So what long-term shareholders tend to do is use options to hedge and to leverage their money. So while they might lose on this side, which is really not a big deal if it's a great company. You don't care, share prices go up and down by the minute, by the second. What they can do is buy a put option. Share price goes down, they can use those profits to purchase more shares on the cheap, which means more dividends. So it's kind of like a circle of economic life, something, if you want to call it that. So, okay, so quick little recap. You buy shares of stock, which gives you ownership. You purchase contracts for options, which allows you to control 100 shares of stock per one contract. And you can buy call options if you suspect the share price is going to go up. You can buy a put option if you suspect that the stock is going down. So you can make money in any kind of market. Okay, so let's give you guys a real life example of the power in options and the power of leverage also. All right, so let me look at my Thinkorswim app right quick. Okay, so today I was looking at, of course, I'm sure everybody's heard of S&P 500, even if you don't even know what it is. So that's what we're going to use in our example. First example. So S&P's ticker is SPX. That's the index. That's not the ETF. The ETF is SPY. But for the purposes of this example, we're looking at the index because that's what I traded today. All right, so did my little technical analysis deal, and I decided, okay, I think based on what I'm seeing on the technical charts or on the charts for S&P, I'm gonna pick up. Well, I think it's gonna increase today. So let's start on the stock side. So to buy one share in SPX right now is 2,000. What is it? 846.07. So that's just one share, right? One share. Okay. So if I wanted to buy 100 shares, because remember, one contract over here equals 100 shares. So we want to keep it uniform here. So 100 shares equals, what's that? 284607. Over $200,000, well, nearly $300,000 just to buy 100 shares over here. So of course, if you buy more, 100 more, then you'll times that number by 2, 100 more, times it by 3, whatever, so on and so forth. So what I did was I went and looked at the prices for the options for this one because, of course, I don't have nearly $300,000 sitting around to purchase S&P. So I went to options because that's more affordable. So at the time that I purchased my call option, which I did say that based on my technical analysis, I saw that the S&P was going to increase today. So I wanted to take advantage of that. So at the time that I purchased, it was probably around what time? I think it was around 28.20. 28.20. I don't remember exactly, but that's when I purchased my call option. S&P was trading for around this price. All right, so remember this is where it closed at 28.46. So about $26 higher, something like that. So what I did was I went and I looked at the options contract. I picked the contracts that expire this week, Friday actually. What's up, Earl? David, thank you for joining. I picked the ones that are expiring this week because I like to get down like that. I don't always advise that. It's highly risky. But anyway, so I went and I looked at the what's called the options chain. That's kind of what it looks like inside the Thinkorswim app. Looked at the options chain and I decided to buy. Hold on, let me see. What did I get? S&P. Is this today? No, that was yesterday. Okay, so I looked at, I chose, what I did was I bet that S&P, I bet that the underlying asset was going to move up to 28.30 today. Remember, it was trading around 28, it was trading $10 cheaper, but I placed a bet on it hitting 28.30 or more by Friday, actually. But you'll see I ended up getting out today. So the cost of this one contract expiring Friday was one contract equals, it was $7.80. So keep in mind that one contract equals 100 shares of the underlying asset. So you have to multiply that 780 by 100. So that's $780 per contract, right? So I picked up two contracts. So that's what's that? 6, 15, 60. Let me make sure. 780 times 2. Yes. So 1560. So basically, I bet $1,560 that S&P will be trading at 28.30 by Friday, right? So remember that it's trading at 28.20, and on the stop side, I would have had to spend $569,000 $569,214 for 200 shares. 200 shares cost me that much money. A lot of money. So of course I'm coming over here, right? All right, so we're gonna stay on the stock side so we can see how it appreciated. So remember, S&P closed up here today, right? We got in at let's see, we got in at 28.20, and then for each 200 shares, we made a profit of $26. So that's a profit of $5,200 on that play. You spent over $500,000 to make $5,200. What's that return? 569, 214 times 100. So that's not even a 1% return. That's 0.91% profit. That's fine. That's cool. Whatever. But let's come over here. Share price went up by $26. Actually, I got out right before the market closed. All right, so remember, I purchased my contract at $780 each, spent $1,560 for those two contracts. So S&P went up by 26, and let's show you what happened to my contracts. What did I sell them? All right. When I sold my contracts, remember $780 at sale, the contracts were $20.20. From $7.80 all the way up to $20.20. Look at the difference. So let's see what those returns are. 20 minus 780. So that's 12.4 divided by 780. So that is nearly 160% profit. Option side, I profited 160%, whereas if I only owned the stock, I didn't even profit 1% off of 200 shares, right? So remember, multiply that by 100, which is $2,020. That's just one contract, right? So I purchased two contracts, remember? So multiply that by 2, 40, 40. So stock side, I spent almost $570K to own 200 shares. I only made $5,200, right? Option side, I spent $1,560, came out with over $4,000. See the difference? Huge difference. This is why options are so powerful. This is why they're so attractive. This is why we all love them once we get a taste. We can't leave them alone. But remember, options don't exist without the underlying. Without the stocks, options are nothing. They don't exist. Remember the definition. They have no value in and of themselves. So what I mean, why I'm saying that is once you get into the stock market game, focus on learning about the underlying asset first. What sense does it make to learn about a derivative if you don't know anything about the underlying asset, right? Focus on the stock market. Options will always be there. Your chance to flip some money, make some serious, some life-changing money is always going to be there. So take your time, learn about this stuff, and have fun with it, right? If you want to learn about it, let me know. Leave your name in the comment box. Email me, Lance at BH Capital Enterprises. Let me turn right. Lance at bhcapitalenterprises.com. Message me, inbox me on Facebook, whatever you want to do. Text me if you got my number. And yeah, I like to talk about this stuff all day long. All right, so let me move on to the little bit of game that I got for my people that are already, trading stocks and options and all that good stuff. How to choose a strike price using technical analysis. So I know, because I used to be one of these people, that there are a lot of people that choose their strike price specifically and probably solely based on what's in their pockets. Because of course, those options contracts that are in the money, close to the money, they're gonna cost you more, right? So you trying to get something way out of the money, you just wishing and hoping that you'll make a return on it, right? But that's not really the smart way to do it. Sometimes you can get away with it if you go out far enough and if the company's share price moves enough. For example, with a company like Verizon, I don't remember. Last time I looked, they were trading mid-50s, not even at $60. With a company like Verizon, you don't want to be choosing strike prices at like 70, 80, 90. That makes absolutely no sense. You're just doing yourself a disservice and you waste the money because Verizon isn't going to get there. Not this year, probably not next year. I've been looking at Verizon for, I don't know, probably 3 years, and they've been trading in the $50 range and $40 range for 3 years or more. So it's a very stable company. But anyway, so how do you choose your strike price? All right, so what you want to do is you want to be looking at chart for a company, right? And we got the prices over here, dollar amounts here, and we got our time down here. All right, so in short, you want to use support and resistance to choose your strike price. Okay, so let me see if I can think of a real life example. Yes. So ticker symbol is Watt. This is a company that provides ancillary products in the cannabis industry, other industries as well, but they do provide equipment for cannabis companies. It's also one of our cannabis options in the greenhouse. But anyway, so let's start with 190 down here. Well, no, let's say 195. 195, 200, 205, 210, 215. All right, so I'm just going to kind of draw. This is just share price type deal. All right. So this is just kind of sort of random drawing of watch chart. All right, so what you're seeing here what's important to note, and this is actually true on the chart, is at about the $210 range. Get another color here. What happens? Notice what happens to the share price. It drops, right? So if I'm looking to make a play on what, even though these contracts tend to be expensive, I don't want to go beyond 210. As a matter of fact, I don't want to go beyond 205 on my strike price, because historically the share price breaks down when it reaches that $210 level, and y'all can go and verify that on the chart if you wish to. So what this top line is called resistance, right? And support is the floor, which might be right here. That's an area of support. Down here is an area of support. But what we care about is mostly what's up here. So, like I said, I'm not going to choose a strike price. I don't care if I'm way out in December. I'm not going for 210, because historically the company showed me that it has not been able to sustain above or at that 210 level. So I'm looking at, I think Watt is trading for 190s right now, something like that. Yeah, I think so. 195, some that kind of range. So seeing as though, like I said, it breaks down at 210 and falls, I don't want a 210 strike, because it's not a very high chance of it getting there. I want to look at something closer to or in the money. So I'm looking at 195, 200, maybe 205. So I'm willing to spend more money, because I'm taking on risks. So I'm gonna spend more money. But if it pays off, I'll also make more money, because it's gonna cross 200 before it crosses 210. By the time it crosses 210 or gets to 210, if I chose a $200 strike, I'm $10 in the money. If I chose a 195 strike, I'm $15 in the money. So my position is stronger, which means more money in my pocket. So that's a pretty simple way of looking at how should I choose my strike price for this company. Whatever company that you're looking at. You can do it for any company. Apple, Coca-Cola, General Electric, Netflix, any of those companies. If you find on the chart that there is a certain price level that the company tends to reverse in the opposite direction, don't go to or beyond that strike price. Never. Don't do it. It's a chance that you might be right, you might make money, but it's a much smarter move to stay as close to that current share price as you can. That's all I got for y'all. Check me out at Introduction to Technical Analysis next Friday, not this Friday, coming August 3rd, 6:30. Hit me up for tickets, $20, pretty cheap. You're gonna get some good information. I discussed an overview of what we will be discussing during that webinar in my last video last week. Thank you for participating and joining me in Wall Street Wednesday. Y'all enjoy the rest of y'all day.